In today's episode, we're diving deep into the complex world of taxes. It's an important subject that can have a big impact on your retirement. We'll talk about 4 tax traps and shed some light on how the tax brackets work. Explore what happens when the government requires you to start spending your retirement savings and how you can get trapped into a sky-high tax bill. Plus, capital gains, dividends, and Social Security, how they're taxed, and what to watch out for. Welcome to Retiring Today. I'm Molly Nelson here with Loren Merkle and Sean Honkamp. They're both certified financial fiduciaries and certified financial planners. Sean is also a CPA. And Loren, really the bottom line is we want to talk about the tax traps because when you don't understand taxes, you can pay more.
Well, that's the sneaky surprise of retirement. And I think part of it's because complacency. We've paid taxes our entire working career. So all of a sudden we retire and, oh, we got to pay taxes. Big deal. We've been paying taxes. The big difference, though, is when you retire, you actually have more control over the type of tax bill that you pay than when you are working, if you apply effective tax planning strategies. And that's what we want to talk about in today's show. What types of tax strategies can you apply to avoid these tax traps?
Yeah, we'll get to those strategies in just a minute. But first, just understanding the tax brackets. The IRS tax code is several thousand pages. This guy here has read most of it as a CPA.
A few times.
Yeah, a few times. You know the ins and outs of it, and knowing the tax brackets and how they work can help you make better decisions.
Absolutely. We know our team gets a lot of questions about taxes, and it can be confusing to understand exactly how these tax brackets and tax rates will apply to you. So we're going to walk through a hypothetical situation for a couple who is married filing joint. Before we dive into their personal information, let's revisit the tax brackets. So currently, there are 7 different tax brackets in the U.S. tax system. You can see the tax rates vary from 10% all the way up to 37%. And then the size of each bracket varies wildly as well. Those are set by the IRS, so there's nothing you can do to make any one bracket any bigger than it is. So even though you may want all of your taxable income to be taxed at 10%, you're only going to be able to apply that rate to a portion of your taxable income. So now back to our couple. Again, married, filing jointly. They had gross income for the prior tax year of $150,000. The first step they get to do is to apply their standard deduction. So they get to take that $30,000, which is their standard deduction for married filing jointly for the prior tax year, and apply that to their gross income. This is going to take their gross income from $150,000 down to $120,000. Now, having that number identified, they get to start using those 7 tax brackets. So they're going to first go to the 10% tax bracket. That's going to apply to their first $23,850 of taxable income. That leaves them with just over $96,000 of additional taxable income to account for. The couple then gets to move over to the 12% tax bracket, which is going to apply to $73,100 of their taxable income. That leaves them with just over $23,000 of taxable income remaining. They then shift to that 22% tax bracket. That's going to cover the rest of their taxable income. And for this couple, this is what becomes their marginal tax rate, which really what that means is how far into the tax brackets did they get? You can see they got into that third bracket of 22%, but they didn't use all of that tax bracket. So if they were to have $1 more of additional income, their marginal tax rate of 22% is what would be applied to that additional income. So this couple has that marginal tax rate of 22%. Their marginal tax rate is different than their effective tax rate. To identify and calculate their effective tax rate, what we have to do is calculate their actual tax bill for each of the tax brackets that they had. So as we showed you, part of their taxable income was at 10%, some of it was at 12%, and some of it was at 22%. If we calculate their tax bill for each of those brackets, you can see those amounts listed here. We total each of their individual tax bills, and it comes out to their total federal tax bill of $16,228. This is how much the couple owes the IRS for their federal taxes for that prior year. To then calculate their effective tax rate, we take their total tax bill of just over $16,000, divide it by their gross income of $150,000, and that comes out to be 10.8%. So for this couple, effectively, they paid 10.8% taxes on their gross income of $150,000. So you can see their marginal tax rate is one figure, their effective tax rate is another figure. But a thing to point out, this couple did not pay 22% on all of their $150,000 of gross income. That was just their marginal tax rate. So it's important to understand these different aspects of the tax system to ensure that for each couple, they can be out there making the best tax decision each and every year for their tax situation.
And that's exactly why people want to understand how those tax brackets work, because even when you're working, having a working knowledge of the tax brackets can influence the decisions you make in your working career, but it can definitely influence the decisions you make when you're retired, whether it's using strategies like let's fill up your tax bracket, or should I convert this amount of money, or should I not convert, should I use a brokerage account within the overall tax plan. All of these things go into it. Having a basic understanding of how you come about your marginal tax bracket, your marginal tax rate versus effective, and how you use the tax brackets is all a part of that tax plan.
And Sean, I know you recently just had this conversation with someone who was maybe thinking they shouldn't take a bonus at work because they were worried about the tax impact.
Yeah, this kind of information was exactly something that I did convey during a Retire Ready call that we had recently. Talked with an individual, the gentleman, he reached out asking about a bonus that he was going to get as part of work. And his mindset was of that marginal tax rate. He thought that that pulled all of his taxable income into that higher rate if he got this bonus and took his taxable income from here up to here. So we just had to have the same exact conversation that we just talked about, letting him know that no, you're not going to be worse off by getting a bonus. I mean, any income that you receive is still, in almost all situations, going to be better off for you. So yeah, we had a really good conversation, and obviously that kind of information, he was able to make a better decision. Like most of us, we probably all will say yes to any of those bonuses. But again, that information was valuable for him and helped him make a better decision.
Yeah, not only because you say yes to the bonus, he had a better understanding of how it would impact his tax bill for that year. So that's just really valuable information you were able to get him in that Retire Ready call.
Yeah, that's something that the Retire Ready call is just wonderful like that, because for some people, they just have certain specific questions to their situation. Some people are just trying to learn more about our firm, what we do as retirement planners. But yeah, that was extremely valuable and helpful for that individual. So he felt more informed. He knew he was going to now go back to work and make that right decision.
If you would like to schedule a Retire Ready call, it's pretty easy. The website is retirereadycall.com. There's a calendar there. You just choose a date that works for you, and then there's time slots available, and you can schedule a call with a retirement planner. You can ask about your tax situation or whatever is on your mind, or learn more about what we do at Merkle Retirement Planning. Really, you can talk about whatever you'd like to. It's a pretty low-key, casual conversation. We'll continue talking about tax traps to avoid next. Welcome back. When taxes are misunderstood, you can pay more. That's why we're covering 4 tax traps to avoid. We've gone over number 1, misunderstanding the tax brackets. Now it's time for number 2, RMDs. I'm Molly Nelson here with Loren Merkle and Sean Hongom. Let's first talk about RMDs, define what they are so people have a clear understanding of when these RMDs hit and how they work.
RMD stands for Required Minimum Distributions, which is a distribution that you have to start taking out of your retirement accounts at a certain age. For most people today, that age is going to be 73 and 75, depending upon what year you were born. But at that particular age, when you have to take money out, it's a distribution, and where it can hurt is that distribution is taxed at your ordinary income tax bracket.
Let's talk about the investments that you typically have to take an RMD from.
The RMDs are going to apply to any of your pre-tax balances that you have saved for retirement. So think about those accounts, that your traditional 401k, your traditional IRAs. You've never paid taxes on any of those balances. So the IRS is going to force you, when you hit that RMD age, to start taking those distributions. The IRS wants their tax revenue.
Yeah.
They don't want you to defer
You've
that, let it grow.
never paid taxes on it before.
You bet. They're not going to allow you to let it defer and grow forever. So they're going to force you to take these out. So you've got to think about it. It applies to any pre-tax savings that you have for retirement.
And how much do you have to take out?
Depending upon your age, but at the start, let's say your RMD age is 73, there is an IRS table that you have to use, but essentially it equates out to about 3.65% of prior year ending balance. So if your prior year ending balance was $100,000, then you need to take out about $3,650 that year. And then it increases. So each year, that percentage that you have to take out will increase. And we fast forward all the way out to age 100, then it gets in excess of 15% of what that prior year ending balance is.
Okay, so if you're watching at home right now, maybe you're age 57 and you're thinking, well, 75, 73, that's a long ways away. I'm not worried about RMDs. Maybe you plan on trying to spend most of your money before you hit RMD age. But guess what? There is a reason to care. And that reason is because you can kind of be humming along, cooking along in your 60s, paying a manageable tax bill. And the trap happens when the RMDs hit, and all of a sudden you get the tax bill, Sean, and you're up in one of those higher tax brackets.
It's the nature of planning. Failing to plan is planning to fail. Even though you're 57, you're here in the ages of 73 and 75, and you're maybe stop listening to us because that's so far down the road, but the time goes by quickly. It comes down to really utilizing that time, making the most of those years that you have prior to these RMD ages that are going to apply to you. So you want to have that plan in place. It really comes down to having the information. If you don't do any planning, you don't have the information, then you're not even thinking about RMDs, and then you do get closer and closer. You don't have as much time to implement certain strategies that can put you in a stronger position. So RMDs may or may not be a problem for you. Some people, they have a plan where they're going to need to take more than that out anyway. Other people that have other sources of income, you may not need those distributions from those pre-tax balances to cover your lifestyle. And then you get to RMD age, and now you have a little less control. And talking about tax brackets, this less control can force you into an unfavorable tax bracket. So it's important to have that information. Get that plan in place sooner than later. You've got more time on your side to be in a stronger position at RMD age.
And this is where that surprise can really come in, because maybe you've retired and you've used a maximization Social Security strategy. Maybe you have a little bit of pension and you're just kind of cooking along, doing well with that income that's coming in. You don't want to take out money from your pre-tax retirement accounts, or maybe you don't want to take out as much as what that required distribution is. But at age 73, now you don't have a choice. You have to take that income out, and it is taxable. So you're taxed on your Social Security, maybe you're taxed on your pension, and then that goes on top of that, which for some people, that RMD amount is enough to push them into a higher tax bracket. And it's at that point, Sean, like you had mentioned, that's when you lose control, because you're not going to turn off your Social Security. You don't want to. You're not going to turn off your pension. You don't want to. And now you have to pile that RMD on top of it. And now you're in this tax bracket forever unless you apply some tax strategies, and ideally, the sooner the better.
Okay, that's a good outline of how the trap works, but we want to help you avoid the trap. So let's break it down and first start with one thing I can do to avoid this RMD tax trap.
To me, it starts with having that long-term tax plan. Really the mindset right now is that you look at the current year and you try to win that year from a tax standpoint. What we do as retirement planners, we help people give them that viewpoint of what the long-term looks like, meaning we're going to have a 20 or 30-year retirement journey. The plans we build, it gives us that viewpoint of what those years look like, what potential taxable income might you be at in the future. We can use that information now to help you make the best decision possible for that current year, which sometimes might mean paying more taxes now than you have to, because we think over the long term it's going to help you pay less. So we can maybe make some of those tax decisions at a younger age, possibly move some of those pre-tax savings into a Roth account or take distributions or whatever strategies might fit. So really have that long-term tax plan so that we can start utilizing that time and be in a better position in the future.
Yeah, and it could even potentially impact the way you contribute to your retirement savings accounts. If right now you're contributing to your pre-tax accounts, does that make the most sense for your long-term tax plan, or should you be contributing to the Roth side of the 401k plan or even the IRA? So really intentional with your decisions, even right now, if you're age 57 and 73 is a long ways away, can really put you in a much better position down the road and eliminate some of these tax traps.
Yeah, so one way to avoid the tax trap, easy for me to say,
Right.
could be a Roth conversion. That's the strategy you were talking about there. Another thing that some people use is a QCD.
Yeah, QCDs. So once you become age 70 and a half, which is a few years before the RMDs come into place, you might want to utilize a QCD. You want to definitely be aware of it. So if you're already charitably inclined, you're going to donate to charities or your church or whatever. Prior to age 70 and a half, you've got to take that distribution, get taxed on it, and then decide how much you're going to donate to those organizations. At the age of 70 and a half, you can now take a QCD, which is a qualified charitable distribution, out of these pre-tax balances, you won't get taxed on it if it goes directly to this organization or that the qualified charitable organization. So now you're in a position where you're still fulfilling your charitable giving goals. You're now reducing the pre-tax balances that you have in your accounts, and that's going to lower the RMDs in the future.
Okay, so we talked about Roth conversions, we talked about QCDs again, those are in your 70s, but I think the thing you can do right now, really if you're 57 or older, is start thinking about the tax bill as a long-term payment.
You have to create that long-term tax plan because the stakes are very high. I mean, if you just look at what you have saved going into retirement in the pre-tax accounts, let's just say it's $1 million. Over the course of your 25-year retirement, you might pay, your retirement tax bill could be in excess of $500,000. So now it's a matter of how do you decrease that? And by looking long term, you can implement strategies today or in the short term to really help impact that and decrease that $500,000 or whatever your potential retirement tax bill is to get it lower.
We've got 2 more tax traps to avoid coming up. Welcome back to Retiring. Today we're talking about 4 tax traps to avoid as you head into retirement. We've covered trap number 1, misunderstanding tax brackets. Number 2, RMDs. Now it's time for number 3, capital gains and investment income. I'm Molly Nelson here with Loren Merkle and Sean Honkamp. Capital gains and investment income are taxed just a little bit differently than ordinary income and some other things in retirement. So understanding how they're taxed, can I help you make the most of these kinds of income?
It certainly can, because this is the tax favored bucket, right? There's the tax free, there's the pre-tax, which is fully taxable at ordinary income. This is the tax favored because you can be taxed less than what you can be at ordinary income if you understand how it works. So this would be a non-retirement account. A lot of people call these a non-qualified account. So you invest into this account and there's no restrictions on how much you put in. There's no restrictions on when you take it out. But the timing on when you put it in, take it out, buy and sell could impact the level of tax you pay, whether it's a long-term capital gain or a short-term capital gain. Because if you sell a short-term security and it's a short-term capital gain, which means you held it for less than 12 months, then you're taxed at your ordinary income. So let's say it's 22%. You're paying 22% on that gain that you realized. But if you would have held it past 12 months, now it's a long-term capital gain, and if you're still in that 22% tax bracket, federal tax bracket, then you're actually paying 15% capital gain tax. So that's a 7% savings right there. And if you don't understand the difference between short-term and long-term, it could cost you an extra 7% or even more, but in that example, 7%.
And Sean, I know I've heard you say the more you know about the rules around this, more intentional you can be with your retirement decisions.
It's the power of information, being able to know that if you wait just a little bit more time and there's immediate savings right there. So that's valuable strategies that you can implement. It just makes me think about the 6 areas that we focus on as retirement planners. Managing your investment risk is one aspect, but at the same time you're making investment decisions, you're going to be impacting your tax plan. So you've got to be thinking about that. Yeah, the markets might be a little rough. You might want to choose something, but you didn't know you're 11 and a half months into holding that investment. If you just waited 2 more weeks and got over a year, still can now make that investment decision, and now you're going to save potentially 7% or so on those gains that you're hoping to get with those investment decisions. So information is powerful, and it's hard to do that on your own because it's the tools we use. It's this comprehensive view that we take as retirement planners as we help people build that comprehensive retirement plan.
Yeah, it makes me think of the buckets. You talked about the buckets you can take from each bucket at a little bit different time, understanding what the tax bill will be when you spend retirement income from each one of those buckets.
Yeah, many times we'll have people come to us where they've managed their investments their entire working career, but they come to us and they say, Loren, Sean, investing into these accounts over the working career was really easy, but now I have to start taking money out of these accounts. And they realize that there's a lot of laws, a lot of regulations that go into withdrawing from these different types of accounts. And it's difficult with all the changing legislation, your life changes, your income needs change over the course of your retirement. And that's why having that comprehensive written plan is so important, because it shows you the rules of the road. If you need $5,000 a month in retirement and you have these different buckets, you have a non-qualified, you have some Roth IRAs, you have some pre-tax IRAs, how much should you be taking from each one of those, not only to provide the income that you need short-term and long-term, but also to minimize the retirement tax bill that you pay along the way.
Do you guys remember at the beginning when I said we were diving into the complex world of tax brackets? Well, we've got one more type of income that's taxed even differently than all the other types of income that we've already talked today. And this is tax trap number 4, Social Security taxation. You guys find that a lot of people are surprised sometimes when they have to pay taxes on Social Security.
And that's because Social Security, in effect, was a tax when you were working. You didn't have a choice. You had to pay into the Social Security bucket. And now when you're retired, when you take Social Security, you can potentially be taxed on that income. So often it does come as a surprise, and we have to understand how taxation on Social Security income works, because it's even harder, more complex than the Roth, the pre-tax, and the non-qualified.
And look, I bet he can help us understand.
I bet he could.
He can. The
See, look,
CPA,
he's all ready to go.
the CPA in the room, help me understand how Social Security is taxed.
I can't recall the specific page number of the tax code, but now we're getting deep into it.
Oh, if only I had my tax code
That's
with
right.
me.
At the break, I'll check on it. But it's when it comes to Social Security taxation, it's this provisional calculation that is part of this situation. So what they're going to do is they're going to take half of your Social Security benefit. They're going to look at the other ordinary income that you have. They're going to add in some tax exempt interest. That's a calculation that they put together, and that determines how much of your Social Security can be subject to taxation. So again, that detailed information, that type of calculation, not anything that you're going to want to do on a given weekend. That's the very last thing on your list. Again, that's where it takes having that information that can help you make these good decisions. Because once you turn on Social Security, you said it before, you're never going to turn that off. Then if you're not having a plan, all of a sudden you hit RMD age. Now you've got RMD income, maybe some pensions. You're going to be in a spot where you're going to have an income floor. You're not going to be able to ever be lower than that. And then that's going to end up causing a certain percentage of your Social Security to be taxed, and it's really never going to change, right? Unless we take the further analysis and maybe take more distributions than we need to beyond RMDs. So you got to have that information to be as efficient as possible with your tax bill.
Yeah, and the breadth of the Social Security percentage of income that is taxed is pretty wide. It's somewhere between 0% of your Social Security income taxed all the way up to 85% of your Social Security income taxed. So that is what that represents is a big opportunity, because if you engage in the planning, you can position your assets in a way where you get all the income that you need in retirement to live the lifestyle that you want to, but your Social Security income could be taxed. Some people get it down to 0, which is a really attractive place to be.
0 tax, that sounds good.
Sounds good.
Let's go back to that retire ready call, because I thought that was fascinating. You talked to a pre-retiree who's considering maybe not taking a bonus because he thought it would take his whole income up to the 22% bracket. In the retire ready call, you were able to explain to him, nope, there's an effective rate, there's a marginal rate, here's how it works, and here's why I would advise you to probably go ahead and take that bonus. That is the power of a short, casual conversation. Just think of the value that added to him, and now he took the bonus and he doesn't pay as much tax as he thought he was going to pay. And I think it's a reason why a lot of people could take advantage of this call and really learn something in a short amount of time.
Our team does a lot of these retire ready calls. We try to make it as easy as possible to help you get the information you might be looking for. If you're facing a specific decision like the example that you talked about, where he's saying, hey, do I take this bonus now? Do I take less? Do I try to kick it into the next year? He didn't understand what the tax impact was going to be. So it's a very stress-free, easy way to have some interaction with someone on our team. You can be wherever you want, whether it's at work, at home, in the car, driving. Let's help you. Let's answer any questions that you're immediately facing, or let's just talk about who we are and what we all do as retirement planners so that you can get more information and hopefully get to step 1 of creating that comprehensive retirement plan.
And I would say don't worry if you have a question that feels silly, because there's no silly questions. Not understanding the tax bracket, that's okay. Most people don't. You're good. But it's pretty easy to schedule that call. RetireReadyCall.com. It's a website with a calendar. You can choose a time and a date. And Loren, really, it's casual. It's a casual conversation.
It's casual, and what you can get out of that is actionable information that you can use. One of the hardest parts about retirement planning is just getting started. And whether you choose to start planning for your retirement with us or some other retirement planning firm, the most important part is to get started. That's what I like about the Retire Ready call. It's an easy way for people to start really getting started planning for their retirement.
This is Retiring Today, and we thank you for watching.
Thanks for watching. Click here for more great videos, and don't forget to subscribe for more retirement planning content.